Welcome to Rich Tribe. You know, we spend our entire lives obsessing over how to make more money. But here's the brutal truth. Making money? That's actually not your biggest problem. Today, we're diving into the ultimate money question. What are some examples of tax-inefficient assets you absolutely need to avoid? Because if you want to cross that gap from the middle class to the ultra-wealthy, you have to conquer the silent wealth killer that's hovering right over every paycheck you earn. Taxes.
Let's paint a picture here. Imagine you're finally making what everyone considers a giant, life-changing income. Let's say $750,000 a year. You're probably feeling like you've totally made it, right? But then Uncle Sam steps in. By the time you get hit with federal taxes, state taxes, local taxes, and property taxes, you're honestly lucky to keep half of what you made. That's 750 grand. It instantly gets slashed down to about $375,000.
Well, hold on a second. You're telling me I could grind my entire life to reach the top 1%, and the government just sweeps literally half of it off the table before it even hits my bank account?
So, if just grinding away to make a bigger salary isn't actually enough to get rich, and more importantly, stay rich, what exactly am I missing here?
John, that is literally the million-dollar question. So let's get into it. The ultra-wealthy, they don't just hyper-focus on income, they focus on tax efficiency. They are completely ruthless about avoiding the wrong assets in the wrong places. They know that keeping their money means navigating around something we call tax-inefficient assets.
This definition right here is absolutely crucial. A tax-inefficient asset is basically any investment that spits out ordinary income or short-term capital gains. And when you hold on to these, you get taxed at your highest possible income bracket. It is a massive, massive drag on your compound growth. So for this explainer, we are completely shifting your mindset from just making money to actually keeping money.
Okay, but what if I'm actively hustling in my portfolio? Like, shouldn't I be in there trading stocks daily, buy low, sell high, booking those profits every single day to speed up my wealth building?
Look, I absolutely love the hustle, John, but no way. That is a classic wealth trap. Research consistently shows that frequent trading actually hurts your long-term returns way more than it helps. See, when you trade constantly, you trigger short-term capital gains taxes on every single win. And they're taxed at your ordinary income rate, which is drastically higher than long-term rates.
So, if you're building wealth in a standard taxable brokerage account, here is your ultimate hit list of what to avoid holding there. Number 1. Active mutual funds that have high turnover and trading activity. Number 2. Short-term stock trades, for exactly the reason we just talked about. And number 3, taxable bonds.
Wait a second. Taxable bonds? Literally every basic piece of financial advice tells me bonds are supposed to be the safe foundation of a diversified portfolio. Why on earth are you telling me to stay away from them? I'm really glad you caught that. I'm actually not saying you should avoid them entirely. I'm telling you to avoid holding them in your standard taxable account. Because bonds generate regular interest, and that interest gets taxed as ordinary income. So this naturally leads us into a millionaire-level strategy known as asset placement.
This strategy totally solves the problem. Asset placement is basically the art of strategically hiding your tax-inefficient assets from Uncle Sam. So you take your tax-advantaged accounts, like your IRA or your 401k, where your money grows tax-deferred or even tax-free, and that is exactly where you stash your taxable bonds and active funds. Then, over in your regular taxable accounts, you hold the tax-efficient stuff. Things like individual stocks you plan to hold for the long haul, passive ETFs, and municipal bonds, since municipal bond interest is usually exempt from federal taxes.
Okay, I think I'm picking up what you're putting down. So I buy these tax-efficient assets like stocks and ETFs in my normal taxable account. I let them compound and grow for, say, 10 or 20 years, and then I sell them for a massive profit and just pay the lower long-term capital gains tax, right? See, John, that's that middle-class mindset creeping back in. Let's elevate this.
If we want to build real generational wealth preservation, we have to look at the whole board completely differently. The average mindset says, hey, I have $1 million in stock. I need some cash, so I'll sell the stock, pay my 20% capital gains tax, and keep whatever's left. But the millionaire mindset? It says, I will never sell the stock. I will just borrow against it. This is the famous buy, borrow, die strategy. It was coined by Professor Edward J. McCaffrey back in the 90s, and it is exactly how today's billionaires fund their incredibly lavish lifestyles. Step 1, you buy assets that appreciate over time, like real estate or index funds. Step 2, when you need cash to live on, you do not sell. Instead, you use those assets as collateral to take out a loan. Why? Because loan proceeds are not considered taxable income. So you get the cash, you pay exactly zero in taxes, and your underlying assets just keep right on growing. And finally, step 3, die.
When you pass away, under our current tax laws, your heirs get what's called a step-up in basis. That basically wipes out all those built-up capital gains completely tax-free. It's literally how dynastic wealth is built.
Now, before I reveal our final and most active strategy for eliminating that massive tax drag on your wealth, I need you to do something for me. If you are serious about keeping your money out of Uncle Sam's hands, subscribe to Rich Drive channel, like, comment, and share. Doing that helps us keep bringing you these deep dive wealth building secrets.
All right, let's look at one more really advanced tactic for high net worth wealth building. It's called tax loss harvesting. Look, even the absolute best investors pick losing stocks sometimes. But a millionaire knows how to turn a loss into an asset. Say you buy shares of a giant tech company, like Apple, and your position drops by 10%. You can actually sell those shares to harvest or realize that loss, and then immediately buy a very similar tech ETF so you don't lose your exposure to the market. Then you use that harvested loss to directly offset the taxable gains from your winning stocks. You can even deduct up to $3,000 a year straight from your ordinary taxable income. It basically creates tax alpha, boosting your after-tax returns while the market just does its normal thing.
Man, that's just incredible. It really all comes down to seeing the financial board from a completely different angle. Instead of just mindlessly buying stuff, you're constantly evaluating the exact tax consequences of holding it. Exactly, John. You hit the nail on the head. And honestly, it all circles back to this incredibly powerful quote from Robert Kiyosaki. An asset is something that puts money into your pocket, while a liability is something that takes money out. Think about it. If you are holding a tax-inefficient asset in the wrong account, that tax drag is literally taking money straight out of your pocket. It's acting exactly like a liability.
So I want to leave you with this final, provocative thought. I want you to look at your portfolio today. Look at every single mutual fund, every bond, every stock you currently own, and ask yourself, are your investments properly placed? Are you actually minimizing your tax footprint? Or are you accidentally spending your life building wealth for Uncle Sam instead of your own family? It is time to take control, optimize your asset placement, and actually keep the money you've worked so incredibly hard to make. Thanks for joining us for this explainer, and we'll see you on the next one.